Tech. Web3 made easy every day. Learn, explore the simple way.
Remember when putting Bitcoin in your 401k was a joke? Today, it's a national debate. The financial world is changing faster than you can refresh a crypto chart. This isn't just Wall Street chatter. These changes are rippling into our daily financial decisions. Smash that like button, subscribe, and ring the bell for the latest in Web3, Polkadot Bitcoin, and Ethereum. Leave a comment to join the conversation, and be sure to share this video to spread the future of tech. The US government just greenlit Bitcoin for 401ks, a massive shift for retirement planning. This opens up a $9 trillion pool to cryptocurrencies, redefining safe for long-term portfolios. It signals a new era for institutional crypto investment. Digital assets were once excluded from mainstream retirement vehicles. Now, millions can diversify beyond traditional stocks and bonds. The crypto market is still smaller than the 401k pool, showing immense potential for adoption. Bitcoin, once fringe, now has institutional backing. Banks are investing in crypto infrastructure and research. Experts like Rick Edelman argue longer lifespans demand higher growth assets. Critics fear crypto's volatility, but the narrative is changing. As people live longer, the need for growth assets outweighs short-term swings. Traditional, safe assets like long-term U.S. Treasury bonds have lost significant value recently. Meanwhile, Bitcoin has shown resilience and long-term growth potential. This reversal prompts investors to reconsider what truly constitutes risk. The generational divide may fade as comfort with digital assets grows. For years, volatility haunted digital asset discussions. Yet, Bitcoin's volatility has sharply declined, even falling below some leading tech stocks. This isn't just a statistical quirk. It's fundamentally altering institutional views. Nvidia's price swings have sometimes outpaced Bitcoin's downside. In 2022, Bitcoin's decline mirrored Amazon's, challenging old assumptions. The Magnificent 7 inches tech stocks have experienced corrections as deep as major cryptocurrencies. While Bitcoin's volatility decreased, traditional safe assets like government bonds became riskier. The TLT bond ETF is down nearly 50% over 5 years, eroding purchasing power. The risk of holding bonds may now outweigh perceived crypto risk. Periods of low volatility often precede major market moves, like a coiled spring. Bitcoin's current stability could be setting the stage for another surge. Is this calm a sign of maturity, or the quiet before the next storm? Institutional investment is rising as volatility moderates. Options and futures strategies are further suppressing volatility. This compression can be dangerous, potentially triggering a short squeeze and FOMO if prices break higher. Ethereum approaches a critical resistance zone, raising questions about its staying power. It lags behind Bitcoin and Solana, which have set new all-time highs. Ethereum has yet to reclaim its $5,000 peak. Wall Street sees Bitcoin as digital gold, but craves the next big thing. Ethereum's smart contracts made it the default second choice. However, much capital flow is based on, what's the second largest one? Developers are increasingly drawn to faster, cheaper blockchains like Solana. Performance, cost, and innovation now drive developer loyalty. Solana and other emerging chains challenge Ethereum's dominance. Large capital pools default to Ethereum for perceived safety and regulatory clarity. Individual traders, mercenaries, chase asymmetric returns on riskier, lesser-known chains. They seek 10x opportunities, pushing innovation further. Wall Street narratives balance Bitcoin's digital gold with Ethereum's tech upgrade. Recent SEC clarity on ETH staking further greases institutional adoption. Is Ethereum's era waning, or just in hibernation? Hey everyone! Thanks for watching Totes Tech. If you liked this video, give it a thumbs up, hit subscribe, and tap the bell so you never miss what's next in Web3, Polkadot, Bitcoin, and Ethereum. Drop your thoughts in the comments below, and don't forget to share this video with a friend who loves innovation. Artificial intelligence is reshaping the entire digital economy. AI innovations are transforming how companies operate and rewriting investment rules. AI's impact triggers a generational shift in financial strategy and mindset. Traditionally, investors flock to blue-chip stocks as safe bets. However, AI-driven digital transformation exposes vulnerabilities in these giants. AI disrupts legacy firms, not robust, transparent code-based assets like Bitcoin. The core strength of digital assets like Bitcoin lies in their code. Unlike fiat companies, they are decentralized and governed by open-source protocols. This makes them less susceptible to AI-driven disruption. AI's influence extends beyond technology, prompting a re-evaluation of future-proof portfolios. With AI extending life expectancy, demand for sustainable, long-term growth assets is rising. Corporate treasuries integrate digital assets, seeking high-growth exposure. My Uncle Bob, a blue-chip believer, remains skeptical of digital assets and AI. My cautious optimism stems from observing AI accelerating digital transformation. Market volatility compression and looming FOMO signal a tipping point. The digital economy is upending everything about safety. Bonds were once the bedrock of retirement portfolios, offering steady returns. Now the definition of safe is being rewritten in real time. Bonds look shaky, tech stocks swing wildly, and crypto feels almost normal. Quote, historically, bonds were stable, but their performance has stagnated. Tech giants like Nvidia have experienced greater swings than Bitcoin. In 2022, Bitcoin's decline mirrored Amazon's, challenging the Wild West narrative. Options markets sometimes price higher volatility into major tech stocks than into Bitcoin. The risk curve is no longer a gentle slope. As macroeconomic policy changes, set it and forget it is obsolete. A new generation realizes clinging to yesterday's safe bets may be the riskiest move. Adaptability is the new superpower for long-term growth. Large capital pools, once wary of crypto, now enter the market as volatility compresses. The risk curve is a roller coaster, and everyone needs to buckle up. Your dad's bond-heavy portfolio might be the bigger gamble. U.S. Treasuries have been the backbone of retirement portfolios, considered the safest. But as the digital economy evolves, a provocative question emerges. What if safe assets are the next big bubble? The iShares 20-plus-year Treasury bond ETF TLT dropped nearly 50% over 5 years. This signals that safe is under pressure. Maybe U.S. Treasuries are actually the risky asset, one analyst noted. Critics ask, why speculate on Bitcoin in retirement? Yet, if Treasuries implode while Bitcoin stays flat, who wins? The answer isn't obvious, highlighting unexpected sources of volatility in retirement portfolios. Market labels for safe and risky change rapidly. What's conservative today could be tomorrow's cautionary tale. Just as tech stocks were once dismissed, perceptions of bonds and crypto could invert. If bonds underperform and digital assets stabilize, traditional portfolios face stress. Tiny allocation choices today could shape generational fortunes. Adaptation and skepticism are valuable investment tools. Investors too comfortable with any asset label may be blindsided. Embrace the volatility and uncertainty defining digital economy trends. The next big bubble might be in assets assumed immune to disruption. The digital economy is undergoing a dramatic transformation, rewriting financial rules in real time. From Bitcoin in 401ks to AI's rise, the landscape is shifting beneath our feet. These trends reshape how value is created, stored, and grown. Traditional boundaries between crypto and macro investors are blurring. The pace of digital transformation means yesterday's innovations are quickly eclipsed. Adaptability has become the new superpower. Comfort is no longer an option. This isn't just for the tech-savvy. Retirees, Gen Z, and everyone must confront that digital assets and AI are not fads. Their impact reaches every corner, from personal savings to global markets. The definition of safe investing is up for debate. Regulatory frameworks are scrambling to keep pace, and behavioral shifts are profound. Are you content to watch from the sidelines, or ready to play an active role? The digital economy's plot twist is not a spectator sport. True safety is less about clinging to the past and more about thinking a decade ahead. Those who adapt, embracing digital economy trends and AI, will be best positioned to succeed. The future belongs to those willing to learn and play an active part. Droplet? Ready to navigate this new financial frontier? Explore how decentralized finance can empower your portfolio. We recommend checking out hydration.net for next-generation DeFi. If your account isn't attached to a referrer, you're missing out on rewards. Use our referral code, HFWM14F today to receive 10% cash back on your Omnipool trades. The content provided on Totes Tech is for informational and educational purposes only. Nothing in this video should be considered financial, investment, or legal advice. Always do your own research and consult with a qualified professional before making any investment decisions. All investments involve risk, and you are solely responsible for your own choices.
Don't stay with Polkadot, the future's bright. Trades connected day and night. Innovation takes its flight. Web3 powered, shining light.